Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.
Welcome back to another episode of the Tech Behind FinTech. I'm your host, Nnamdi Osuagwu. I'm joined by Ben Maxim today. Pretty exciting show. Ben, how are you today?
Yeah, doing great. Thanks for having me on.
Wonderful. Today we're going to cover credit unions and FinTechs harnessing data for growth. I'm going to go over Ben's background. Prior to doing that, let me just do some housekeeping stuff. We are live from shooting live from Instagram. We have a feed on our Tech Behind FinTech page. We're also shooting live from Facebook, LinkedIn, YouTube, and Twitch. Get that going on. Get comments as always. We love your comments. They're always welcome. Please feel free to drop it in the chat on whatever platform you're in, and we will answer your questions or provide or give insight to the rest of the viewers. So without further ado, let's jump into today's episode of the Tech Behind FinTech. Credit unions and FinTechs harnessing data for growth. I'm going to go over Ben's background, and then we'll jump into it. Ben Maxim joined MSU Federal Credit Union in 2007 and currently serves in a dual role as Chief Digital Strategy and Innovation Officer for MSU FCU and as Chief Operating Officer for MSU FCU's wholly owned CUSO Reseda Group. He is responsible for assessing emerging business trends and technologies, providing strategic direction for existing and future digital channels, facilitating innovation throughout the credit union, including leading their innovation center, the lab at MSU FCU. He's also responsible for the technology, product growth, and sales at Reseda Group. Maxim began work initially as a web developer, and in 2014, he became e-commerce manager before moving into roles including assistant vice president of software development. He earned a bachelor's degree from Michigan State University and a professional certificate in innovation and entrepreneurship from Stanford University. Maxim was honored as a FinTechs 2022 Techie Awards Technologist of the Year. Maxim completed Feeling Research Institute Innovation Leadership Program I3 in 2023. He also serves as an advisor and board member to multiple FinTechs. Welcome, Ben.
Yep, thank you.
So pretty exciting today. So it's actually our first show where we're actually getting into credit union. So I'm very interested. You know, in thinking about it, I had to go back in my history, and I remember my university at Temple, we had a federal credit union on campus, and that was my first bank account. Not my first bank account in general, but my first one on campus as a freshman. So it brought back some memories.
Absolutely. So yeah, no, we're a university-based credit union. So I think a lot of people find us when they come to Michigan State's campus and are looking for their first first adult grown-up account that maybe their parents didn't open for them. So, we have a lot of members come to us that way as well. My first account ever was with a credit union that had a program in our elementary school where, the students worked as the tellers, and you could come in and also deposit, your allowance or whatever. I've never actually had a true bank account. I've always had a credit union account. So I started with one credit union, then when I came to MSU, opened an account with MSU FCU, and then, I've kind of always been in credit union world ever since. I have had financial products with other institutions that are banks, but my primary banking has always been with a credit union. So I guess I from the other way, thought that's all banking was the credit union space kind of growing up. So it's kind of fitting that I now am so involved in the industry here.
It's interesting. You're what they call a true believer, man. Like
Mhm.
you not only like work in the space, you actively have your personal accounts. Because I come across different organizations that they may target, whether it's a credit union or a community bank and so forth, but like all of the people that work there don't have accounts at these places.
Right.
So I found that interesting. So you're on the opposite tail. From elementary school all through your adulthood, you've been at credit
Yep.
unions, now you're working at it. So, you know what? I want to get into some stuff. I did some research on, it's one of those things you always see from a person who's not as familiar with credit union. You always see it, but sometimes you don't really know the details and the differences between a credit union and a traditional bank. So I would like to get into that just to set the stage before we jump in hard into the technology aspect, right? So let's go over some ownership structure, right? Between the difference between a credit union and a traditional bank.
Yeah. So, traditional bank, they have shareholders, they have, and that's who they're ultimately responsible for. They have customers instead of credit unions have what we call members. So we are a member owned cooperative. So each member has an equal share in the credit union. Again, shareholders, the more shares you own, the more ownership stake you have in the bank. So credit unions are a cooperative where everyone has an equal share in the experience.
I have a question for them. When they say member
Yeah.
owned, are those the account holders, the actual bank account holders, or are they different?
Nope. So as part of opening your account, it's usually a small amount, like $1, that's held as your membership, buy-in share. Every credit union has a membership share amount, but everyone has that $1 share that you own. So you can have 30 accounts but be one member as well. So I think we also look at the account structure differently. You can have one membership account, and then you can have under that one membership account your credit card, your mortgage, your car loan, a personal loan, your checking account, your savings accounts, all under one membership account. So when you open that membership account, and we call them, sub shares or sub loans, but they're all one under this base account number. Quite often, at least my experience in the banking world is, your credit card's one account number, and this is another account number, and your mortgage is a different account. You can see them all in digital banking together, but they're all different account numbers. You have one account number with different kind of sub products below it. Might be some of the structure as well. But yeah, the owner is the account holder, but it's that base account level.
Okay, that's interesting. So I go in as a just a regular person wanting to open up a bank account in a credit union.
Yep.
And now because of that, when I open that account, I become a member owner of that institution. Is that accurate?
Yes, that's 100%. You got it. Yep. And credit unions often are affiliated either with a community, and the community can be as large as an entire state. And there's kind of 3 levels of charter. There's a federally chartered credit union, which is what MSUFC is. We're able to operate anywhere in the country, but we're affiliated with usually an employer or a series of employers. So us being Michigan State University. Then we have some other select employer groups that we've added along the way, but that allows us to operate in kind of any state. There are state chartered credit unions that can operate in kind of the entire state. So we're based in Michigan, so there are other credit unions in Michigan that anyone who lives, works, or worships in the state of Michigan can have an account and membership with that credit union. And then there's community chartered credit unions that are then a little bit more localized to maybe a series of 3 or 4 counties with that kind of similar. If you work, worship, or live in that area, you're eligible for membership.
So like let's go through the traditional bank, but I want to understand also the difference between a credit union and a community bank after we go over the differences between the credit unions and the
Absolutely
traditional bank. So another aspect, the profit motive, right? So from reading these notes, it looks like your credit unions are they're nonprofit.
Correct. Yes, not for profit, and really what that translates to, and you have it here on the slide. But we reinvest back into the members. In every credit union treats that differently. It's by providing lower cost services, better loan rates, higher yields on deposits, and we're seeing that a lot now as the interest rate has ticked up. Credit cards with some of the major banks can be 30%. pretty easily. Credit unions can't go more than 18% by regulation. So a lot of us still have cards that are, and they're not linked to, the prime rate either, many of them. So as that, prime rate is ticking up, your interest rate staying the same on that credit card at a credit union as well. There are some loans that we do index to that prime rate, but for the most part, we kind of have pricing that fits for our industry, and that's because we're not for profit. We're not, looking to return a dividend to shareholders. We're looking to return value to the members, which is why we're formed, and that's where that member ownership cooperative really comes into play and really kind of shows and demonstrates the difference between the two.
So, why then would someone go with a traditional versus a credit union? I mean, it's just from that aspect alone, in terms of the cheaper products, the credit
Yep.
cards and things like that, it seems like it makes more sense to stay for credit union. What are some of the reasons? And what
I think kind of the biggest thing I think we hear, so when people give credit unions a try, they fall in love. They're like, oh, why did I not do this before? There's a perception that credit unions, because we have membership, well, maybe I probably can't become a member. So that's already like, oh, I can't join. Most people, we can figure out how to get you qualified to be a member at most credit unions. There are some restrictions to that, but there is a credit union somewhere that you qualify for everybody. Some credit unions are smaller. We're the Michigan State Federal Credit Union is the 43rd largest credit union in the country. So we have a larger scale. And so there are many credit unions that are very tiny. So for kind of perspective, we're approaching 8 billion in assets, or I think officially at 7.6 at the moment. There are credit unions that are as small as 5 million in assets, and a lot of them are very, very small. They're probably related to one employer or one small community, and they may not even have full-time employees working for them. We have members, even for us, that don't realize we can do mortgages. They don't realize we can do certain products. So they kind of don't think of us as a full service financial institution. They also see, Chase ATMs everywhere or Chase branches. Credit unions have pooled together to create a network of ATMs and a network of branches. So that basically we allow each other to kind of share services across the board. So that ATM network has about 40,000 ATMs across the country. The shared branching network, I don't remember the number, but there's tens of thousands there as well. And you can kind of walk into any of the institutions. But there's this kind of safety that people have when they see that branch, they see that logo. Even if they're going to do everything digitally, they're going to want to have that safety. I know I can go in somewhere, and they see that kind of affiliation with that. So we've been trying to branch more and do a lot better job of telling how you can do your banking with us everywhere. And then kind of digital is another component where it is very expensive to offer a lot of these services. That's where partnering with FinTech has really helped us kind of advance what we're doing and extend that reach and really deliver more services. We don't have I forget what Chase's annual spend is on tech, but I think it's upwards of $2 billion a year or something like that. And that may be a dated number, but we don't have that kind of budget. So how do we, and a lot of the stuff they're building or acquiring companies, how do we partner and work with companies that are maybe earlier stage that were founded kind of with the same mission that credit unions were to kind of fix the broken financial system or aspects of it, where credit unions like MSUFC were founded in the depths of the Great Depression from the National Credit Union Act of 1934, where people affiliated with different groups couldn't get traditional banking services. MSUFCU's faculty got together and started it out of a desk drawer in a campus building. They brought together 10 people. Anytime someone needed a loan, 10 people would get together. When someone needed $100, 10 people would deposit $10 right there on the spot. And that's how they did lending in the 30s to kind of make this work at the beginning. It's obviously grown to be more full service, but I think people still think they're not fully capable of delivering all these different services, either digitally or kind of with the reach that we do have kind of as a network of institutions.
You know what? And then, I mean, I could totally understand that perception in terms of, I'm going to go with it. They might not have the full suite of services as a traditional bank or an incumbent. So, that may prohibit me from leveraging them, or I might just use them for a savings
Right.
CD. I can't use them for the full gamut of products. Look at some other aspects, right? So we already touched based on the membership, where credit unions are membership based and the banks are open to the public. So regulation, right? They're primarily regulated by the National Credit Union Administration.
Yep.
They're the popular or insured. So it's the same 250. I mean, it seems like
exactly.
It's the FDIC, and from the credit union perspective, it's the NCUA.
Yeah,
Okay.
absolutely. So you can think of those as almost interchangeable, how they function and work. So if you're familiar with how the FDIC works and the insurance provided there, NCUA works very similarly. So yes.
Okay. Got it. So rates and fees, due to their not-for-profit, you covered this, right? They often have you save from the higher interest rates on savings. I mean, you make more on the high interest rates on savings and lower rates on the loans. All right.
Yep,
The
absolutely.
banks offer competitive rates, but generally their rates and fees are higher than those of credit unions.
Yep. And maybe another thing too, because we're more community based or really more kind of focused on a community or a population of members to serve, we're tend to be a little bit more inclusive. We don't have some of those fees that, if you want to have a checking account with us or a savings account, you must maintain, $200 in your account all the time in order to avoid all these fees. Because a lot of times those larger banks, the larger regional banks, are really catering to that higher affluent customer because that's where they're making their profit and that's how they deliver that shareholder value. Credit unions, again, everyone has the same member owner share. So we're providing financial services to people that are sometimes not able to afford those bank expensive fee accounts.
That's very interesting. Like you touched on this in terms of service and community focus, right?
Yep.
That's really one of the biggest focuses of credit unions versus the larger banks. And what else do we have? Accessibility. So let's talk about that, right?
Yep.
I know you mentioned that. That's another thing. So not as many branches, right?
Correct.
But you mentioned you touched based on this shared branching networks to allow the use of services at other credit unions. So real standard question, right? But are there fees attached? So like, let's say you can't get access to this branching network, and you go to an ATM at another bank. Would you get those fees refunded, or those same fees apply? But it might be different per credit union in terms of their stuff. It might not be
Yep.
generic.
So all credit unions have the opportunity to participate kind of on the receiving side. So allowing all credit union members to use their ATMs as part of the ATM network, and the same thing with branch services. You kind of pay as the institution versus the member having to be charged for it. We all appreciate the extension because we can't put branches everywhere where it's not possible. So it's quite affordable for us to then buy into these networks and provide what we need to. So the co-op ATM network. So if you see the co-op logo on the back of your card on the ATM, and a lot of like 7-Elevens and some others participate in this network as well. But the credit unions, there's no fees. Some credit unions do offer the reimbursement if you do. Let's say you end up at a Chase ATM because that's your only option. They do that. Not all credit unions do. But there's usually enough, there's 40,000 of them. They're very geographically diverse. You can find one pretty much anywhere you're at.
This is I think that's it for the slides. So, I mean, you just gave me a whole education on credit unions. I mean, because I didn't know. Like, we obviously approached you to be a guest on the show for the knowledge of that. So thank you. You mentioned that your credit union was starting in 1930, so it's almost as a disruptor, right? So it's
Right.
almost like you guys were like an original FinTech, if you think about it.
Yeah,
Right?
you can think of it that way for sure. Absolutely. Yep. Absolutely.
Very interesting. So let's kind of go into what from the technology perspective, because you mentioned that the Receiver Group is a CUSO of MCU FCU. For those that might not have heard the term, I was not familiar until the show.
Sure.
It stands for Credit Union Service Organization. So can you explain how that works?
Yeah, absolutely. So credit union service organizations create solutions. So they may be tech solutions, and a lot of them in the more recent years are really technology focused, kind of traditional FinTech, if you will, just happen to focus on serving credit unions. And then, traditionally they've been things like title companies, insurance companies, mortgage companies, realty companies, things that are kind of ancillary to the banking transaction or the credit union transaction. So you get your mortgage with a credit union, but you can then get your title insurance through a CUSO that the credit union had started. a credit union service organization is defined as a company that is primarily serving credit union members, but that can be defined in a number of ways. So you can be a FinTech who's formed a QSO, and you can set up a structure in two ways. So one is you have your parent company as it is, and you have a credit union focused QSO that's a subsidiary, or you can turn your whole company in if you're only going to focus on credit unions into a QSO. But 51% is number of users, number of clients, revenue. So let's say you had 20 clients, 15 of them are credit unions, and your other 5 clients are Wells, Bank of America, US Bank, and 2 other large players. You can be primarily serving credit unions because you have more credit union clients that you're then serving as well. So for the FinTechs listening, we've had a lot of FinTechs come through, so what Reseda Group was founded to do was to help provide opportunity for technology companies to serve credit unions and understand it better. We do a lot of kind of mentoring education. We were working with these companies at MSU-FCU. We have an innovation lab, the lab at MSU-FCU, where we were partnering with them, doing pilots, being their first customer, and they were ready to then scale their businesses. Credit unions by regulation can invest up to 1% of their assets into a QSO. So we decided to form the Reseda Group QSO to receive that 1% from MSU-FCU. And then we were able to, the way we operate, that 1%, because we're a holding company, a subsidiary of the credit union, anything earned within the QSO can then be on top of that 1%. So that's why we set up the structure we did and why that investment's going there. We do 2 things at Reseda Group. We invest in FinTechs to really help amplify them, take the companies that we're working with and make them ready to work with other credit unions, and really make sure that they have the opportunity to grow and scale within the credit union space. What we were seeing previously is that we have a great traction with a FinTech partner. Then that FinTech partner would start to get in with, some of the bigger banks, or maybe a big tech company wanted to buy them. And then all of a sudden they're shut out. We're not able to use them because they're really focused on the banking world and they're not serving credit unions. So really Reseda Group was founded to make technology accessible to the entire credit union industry. We help the companies that come through and we invest in sell to both credit unions and community banks. You mentioned them earlier, are also a good target because we're trying to do a lot of the same things within our communities. One of the big focus areas, community bank versus credit union, is community banks tend to be a lot more small business focused or business commercial focused. So a lot of their community involvement is around the business community. Credit unions tend to lean more on the consumer side, and we're not kind of both playing in each other's space. So the more that the FinTech world has kind of started to blend, what does that look like? So a lot of the FinTechs we're working with serve both banks and credit unions. We at Reseda Group are serving banks and credit unions with some of the technology we've acquired, built as well. We also, as we were investing, started to see some gaps in the product space that maybe wasn't out there for us to partner with. So we started building some solutions, especially in the financial literacy space. And then also in some of this, we have a product, One Click Financial, that allows, it's kind of like a platform layer. It allows for hyper personalization at scale. So all this great data that we have at a credit union, we could then leverage that with that platform and then provide very tailored, product and cross-selling, but also education materials, insights into how they're performing, and a lot of things like that. We can go in more detail on that, but kind of the original question, QSO is a way for an organization, a FinTech or others to kind of serve for the credit union marketplace.
So let's take a step back. There's a lot of good information.
Absolutely. No, for sure.
Have some questions to just kind of drill in a bit.
Yes,
so
of course.
The first question is something that I quote that you mentioned. In order to be a QSO, you have 51% of your customer base or clients has to be a credit union. Is that accurate?
Yep. Correct.
Okay.
Yep.
So now, right, understanding that, what if you have that situation where 51% of your clients are credit unions, right, that you're servicing, but you're not officially a QSO, what benefits, like what's the process of becoming one? And then what are the benefits? Why can't you just say, you know what, I service credit unions 51. In 2023, 51% of my clients were credit unions. 2024, we did some advertising, we got some large banks, we fluctuate. What's the advantage to then, and the process in becoming a QSO?
Yeah. So the process ones, I'll answer that one first because it's very simple. So it's an application process. It's usually, there's a lot more to set up a structure if you're going to create. So there's 2 ways you can do it. You can make your whole company a QSO. And if you make that decision in 2023, because you're primarily serving credit unions, and then you start serving a lot more banks, you can then split off a QSO subsidiary and then have, kind of a C Corp or whatever structure you want for your business, again, to serve everyone else. Then you would just package up all your credit union business into that QSO. The advantage is it allows you into a lot of credit union events that you're not able to come to if you're not. You also get into a lot of industry publications for credit unions, and it kind of demonstrates your commitment to serving a credit union. So if that's where you want to be, if that's your focus and your target, adding that QSO kind of branding or kind of distinction allows that to be a lot more easily like, oh, you're a QSO. I get like credit unions looking to buy services get immediately, oh, you're a QSO, you're focused on us. We all work with all kinds of vendors that are not QSOs. So, you got to do what's right for your business. So to any FinTechs listening, do what makes sense for you. If you're serving credit unions and you like that and you want to maybe take that to the next level, form a QSO. It's not expensive. If you were to form the subsidiary QSO, it's a little bit of legal paperwork, but it's no different than if you were to form an LLC kind of on your own right. It's really quick. We've helped about 20 companies go through that process so far. And there's one law firm that kind of wrote the book on becoming a QSO, Messick, Lauer, and Smith. They actually, literally, you can buy the book on becoming a QSO. I forget the actual title is on Amazon. But a lot of our companies, we work with them. We use them to become a QSO ourselves. A lot of our portfolio companies, as we're investing, and we have to invest in QSOs as well. So we can't invest in any. So if you want to receive, and maybe that's the other benefit as well. If you want to receive credit union strategic investment dollars, becoming a QSO is what enables you to do that. So maybe that's probably the more tangible benefit. So if you want to receive kind of that strategic investment money from a credit union, that's the number one reason probably to go through the effort to form a QSO.
That's interesting. So just to be clear, right? I have a corporation, a FinTech that I'm running, right?
Yep.
Right now, let's say that I'm been going hard in the credit union space and other spaces. I'm trying to just get business, right? To get.
Absolutely.
As the business starts to grow, and I apply for a QSO, that main entity is now a QSO. But then I can say, okay, you know what? I'm also getting business on this other layer. So now I want to create a subsidiary where this will be the QSO focused wholly on credit unions, while my other division focuses on other banking verticals.
Yep, absolutely.
Okay.
And I may also just add a caveat too. It doesn't have to be just banking verticals. We have a lot of companies that are in like insurance and some others as well. There's some companies that are more kind of loyalty rewards based. So they're doing things in other industries like travel or retail beyond just, and banking, credit unions are one vertical of many. So they put that QSO business into one credit union vertical.
That's very interesting. So we have a comment from the audience. Let's like to definitely give that a shout. So Brian says, great conversation, guys. Extremely helpful to better understand the credit union ecosystem and how Receiver is supported. Awesome. Thanks for the
awesome. Yeah. Thanks, Brian.
Appreciate that. Yeah. So this is like a whole new world for me. So I'm loving the conversation also, Brian. All right. So number one, you're a FinTech looking for some investments, and your focus, your services can benefit the credit union space. And then, so what if you're just starting out, right? But you don't have clients yet per se, but you think your service can really be helpful for the credit union space. Do you actually have to have listed customers in order to become a QSO, or can you just out the gate say, you know what, we're going to become a QSO, and here are our services, and we're going to start, marketing towards this vertical?
Yeah, no, you could absolutely become one out the gate. I would recommend, ensuring the fit with credit unions. So at least have some conversations to make sure that the credit unions feel the same way about you that you feel about them. Just to validate that, right? Just because that's smart business, right? You want to make sure, test the idea in the marketplace, right? So bring it to some credit unions. There's a number of different events that credit unions are at throughout the year. There's a lot that are they're starting to become more and more for kind of companies that have ideas. They're ready to find those first clients. We have an event kind of in the credit union space coming up, Venture Tech. So you can apply, and the rounds are all done now because it's just in a couple of weeks. But what they do is they allow, credit unions, QSOs, FinTechs to apply FinTechs to apply to kind of be discovered, if you will. There's also True Stage Ventures, which is part of the True Stage company that provides a lot of insurance services to the credit union market space. They have a discovery fund that's looking to fund underrepresented FinTech founders as well. So we've co-invested with them a few times. There's a lot of spaces you can go. We as credit unions go to things like Finovate and Money 2020 to meet new and upcoming FinTechs. And there's a lot of different kind of pre-seed, very early stage things. There's a lot of accelerators that are existing right now. FCU is partnering with Michigan State University and the Michigan State Research Foundation to create an accelerator for InsurTech and FinTech, which we're launching applications December of this year, and the first cohort will be in March. So if you're very, very early, there are a number of accelerators that are out there that can help you kind of get into the credit union space and test that market fit and get some feedback from credit unions before you go forward and maybe go all in that market. But I think, there's nothing stopping you from becoming that QSO day one. But getting into credit unions, like you do any market, make sure you do that true test to make sure there's a fit and that you want to be there. So
I know that's good information. You mentioned Money 2020. I'm gonna actually be there.
Me too.
Cool. So I'm gonna get up. Maybe we're gonna do something called Tech TBF, so Tech Behind FinTech on the go. So I'm gonna maybe
very cool.
I'll in their app. I'll request a meeting. We get to meet you.
Perfect.
Face-to-face. A couple of past guests are gonna be there, so we get to see them face to face. So next question, right? How do you envision the future partnerships between credit unions and companies?
Yeah, absolutely. So I think, credit unions and QSOs and FinTechs and community banks, we're all trying to solve the same thing. We're trying to help our communities grow. The FinTechs really have some kind of niche focus, and there are things that we can never do as well as they're doing. So we've taken the approach of partnering with FinTech to create a personalized experience for our members at MSUFCU. Reseda Group's mission is kind of help curate that same experience and provide enough spread of different technology so other credit unions can also take advantage of that kind of a hyper-personalization experience. Reseda Group is trying to build connectors to make it easier for credit unions and FinTechs to kind of have a single layer, a single point of entry to get in and out of all these different disparate legacy banking systems that we all have. And to really make that an easier process, because there's a lot of different core systems, a lot of different digital providers. So we're trying to make the layers that make it easier to connect, kind of as a product from Reseda. But really the true opportunity is to work and focus on this financial inclusion opportunity before us. So there are a lot of people who are, and it's not just the underbanked, there are a lot of people who have banking accounts who are shut out of traditional products. There are a lot more gig economy workers that don't have the traditional underwriting criteria. So there's a lot of FinTechs doing like cash flow underwriting and different things. So you may have 3 jobs that pay pretty well, but you can't get a mortgage, you can't get a car loan because you don't have a W-2 income. There are products, that just don't make sense unless you have, income, through the roof. There are things in wealth tech and wealth and building generational wealth is one of the best ways to help families generationally kind of move forward and kind of get out of this kind of cycle where they're kind of stuck with the payday lenders and not being able to get into financial services. And FinTech is doing that kind of democratization, things like fractional share investing. You may not have, $800 tomorrow to go buy a share of Tesla, but you might have $5 you could invest every week, every 2 weeks when you get your paycheck you can start to grow and build. You can help people build savings. And that's something we're seeing a lot more right now. There's a lot of gamification that can be done to kind of help incentivize people to do maybe what's hard for them to do on themselves. There's a lot of behavioral science going into, I think some of the more successful FinTechs I've seen lately are in this kind of behavioral science understanding of how people interact with money in the world. And they're trying to do things like, example of like Noom, where people are then learning the psychology behind, how they need to eat better. They're also learning the psychology of how they can do better with their money. And it becomes a habit and it's habitual and behavior changing versus just, hey, if I do this or automate it, then it's done. But it's really easy to break that. You pay off all your debt, but then you have all this access to debt and maybe you fill it right back up again if you didn't learn why maybe you shouldn't have done that in the first place. So there's a lot of opportunity to increase financial literacy, to increase access to products and services that are traditionally geared and marketed towards more affluent customers. And FinTechs are doing a great job of bringing those, to everyone and making them accessible. And I think that's one of the coolest things that startups in general have done for a long time. And we're seeing a huge kind of movement, influx, amplification of that in the FinTech space, especially over the last couple of years.
I mean, I could attest to, I'm also in the real estate space. I've been doing that for a while as an investor. Getting the mortgage process, I mean, when you're getting a mortgage as the investor per se, you're doing it through an entity, very low doc underwriting is pretty straightforward. But you're doing it as an individual and a primary residence, the underwriting, as you mentioned, from traditional banks is astronomically through the roof.
Right.
And to your point, I like that you said that they don't take into account other sources of income. It's the W2 is the holy grail of everything.
Right.
And even if you do have other sources, depending on the situation, they'll totally ignore that and scratch that off. So it's a really interesting situation, especially if you can be the credit could be there, everything could be there, but yet you could have reserves, but yet you cannot get a traditional mortgage.
Right.
So
absolutely.
Interesting. That's a great point that you brought up. So a lot of people don't really think about it. They'll think that, oh wow, this is the only way, and if I don't meet these criteria, then I'm shut out of getting a home, my first home.
Absolutely.
So
yeah, maybe another point to how FinTechs can really help amplify what's happening too is, banks the size of Chase have millions and millions of customers. So they have data sets that allow them to train AI and do a lot of the cool things that you're hearing about kind of in that AI cutting edge space. Whereas credit unions, we have 340,000 members and we're a pretty large credit union. A lot of credit unions have 100,000 or less. By FinTechs having multiple clients and working in kind of larger data sets, they can start to bring some of that ability that, a large institution like Chase has on their own, kind of in a consortium of credit unions, if they have more clients and the credit unions are willing to participate with their data, to really train some really cool models and do a lot of cool stuff that can't be done individually. And a lot of what FinTechs are trying to do for us is either unlocking data and insights for our kind of members directly, or for the institution, the credit unions, to be able to then better serve our members. So having larger pools of data, which FinTechs are able to attract because they have access to it, is also, I think, another way that we can kind of amplify again what we're all trying to accomplish.
So, and that's a good point. Let's talk about that in terms of data and the harnessing. But in dealing with from a FinTech space, being in that space and security space, one of the things that we come across is everybody kind of wants to have their own wall on their data. So now you might be FinTech and you could be dealing with various banks and different things of that nature, but the commingling of data, sometimes they're like, they want to ensure during the vendor due diligence process that their data is going to be separate from other. You could work around and anonymize certain things, but in the contractual aspect, sometimes you have to kind of state that and say, okay, how is your cloud infrastructure going to support that?
Absolutely.
Are you so in the credit union space? Is that an issue or that?
That's a very real issue, credit union space as well. So there are some ways to encourage that. Again, there's the anonymization, the de-identification, there's synthesized data. There's some stuff that's trying to help maybe make more credit unions comfortable sharing that information, and being able to provision it and have the rights to say no or yes are important. If you're a FinTech, don't try to do this without getting express permission, for sure. And there's going to be contractual things happening. And for any credit unions listening as well, make sure that you're comfortable and your risk and compliance and everyone else signed off on any data sharing that's happening. What we try to do to kind of help amplify what's happening with FinTech and test out ideas quicker in our innovation lab is to use some of the aggregators that are out there that allow the member to expressly say, yes, FinTech, you can use my data because I'm going to get this perceived value. And a lot of customers are willing to give up some of that privacy to their data if they're getting an actual value. What they don't want, is the equivalent of like the telemarketer call every day. They don't want spam email. They don't want to be sold something. They don't want someone harassing them online or wherever. They want to come do their business. And if you can do value add with their data, that's gold. Think of how much, personally you all maybe have given up to Amazon or some of these other services because they tell you what you want to buy before you want to buy it. They have a lot of knowledge of what you're doing. Google does the same thing. Google's very smart. They figured out, oh, we can give you all these free services, but in the background, you're going to be giving us all your data and all those emails you're reading. That's why you get Gmail for free. So there's stuff that, companies have figured out over time, that then people start to question, why did I give that? You see things like Facebook where they're doing, things, a few years ago where they're manipulating us based on that data. So I think that's made people hypersensitive to who they give their data to. And it makes it harder, I think, to, blindly get that trust. But if you can start to deliver value, you will get that acceptance from both the institution and the kind of customer. If the customer's on board, the institution will. And some of the stuff kind of to the regulator side of it, there's a lot of things with AI that if it's not explainable, transparent, there's not the transparency, you just can't do. There's all that worry about bias and all the things that we've kind of regulated out of the system kind of in the manual pre-AI world, will all come back if they don't do it. So that's kind of the biggest fear. So yeah, making sure that you're provisioning that data, and if you don't commingle it in your database, make sure it can be separate and then permissioned appropriately. You get express permission from the business, from the user, and you have that all documented. And yes, there are going to be people who want that stuff separate. If you're an international based fintech, we ask that when you're in the cloud, it's in AWS in one of the data regions in the US. So there are things like that that definitely come into play.
So when you say things like that come into play, I mean, I know from like that goes with your compliance, and you'll have different compliance standards that have to be adhered to make you do business with. All right, makes sense. Question I had, I want to switch back to data after this question.
Absolutely.
Earlier this year, there was a whole big thing with regional banks closing, different things of that nature. I didn't hear of credit unions facing any of those types of issues. Is that something that has happened historically with like credit unions shutting down or facing insolvency issues and things of that nature? I've actually, in thinking about it, I haven't heard of it. I'm not saying so. I'm going to kind of take your background on that.
Sure, absolutely. So I think some of the regional banks that we saw shutting down earlier this year, a lot of them had a lot of concentration in certain areas. Some of them was just like Silicon Valley Bank, overly connected into an ecosystem where some people on Twitter were able to amplify them a message. They said, hey, we have this thing which should have been a non-issue based on the size of their balance sheet. But then some people got scared, and then traditional run on the bank, right? Credit unions tend to be more conservative and more diverse in what we're invested in and what we're able to put the members' money, and we do treat it as though it's the members' money. It's not for us to do whatever we want with. It's again, we try to focus a lot more on that giving back to our communities, to our members. How do we benefit them that way? And we're not selling off a lot of things. And the interest rate squeeze that we've all been feeling, which also led to a lot of the issues that those regional banks had, has affected all of us and has reduced our income, our operating ability. But credit unions tend to have a little bit more, because of our more conservative approach in general, tend to be able to weather some of these storms a little bit better. And quite often, when there have been downturns, I've been in credit union working since 2007, so started right at the time when the 2009 recession hit. And we grew a lot because people started to put their trust in us. During COVID, we grew a lot because people put their trust in us. There was some shop local kind of feel to that as well, especially during COVID. And then as the regional banks were having problems, we even had some of our portfolio companies like, oh, maybe I should move some of my funds to you because you're all set. And for the most part, people are under that. You showed the share insurance at the beginning between the FDIC and NCUA. Most people, kind of operating their day to day are under that amount. So helping people understand that they are safe and secure there. Credit unions and what we're seeing. So when I started in the industry, there was about 6,500 credit unions, I think roughly. At the beginning of this year, we were saying there's about 5,500. We've seen a lot of consolidation. A lot of those smaller credit unions, because of the compliance, because of the technology demand, are having to consolidate and merge together. And some of the larger credit unions and the medium credit unions are absorbing some of these very small credit unions that can no longer stand on their own. So I think that's what we're seeing in the credit industry. Not that there's anything wrong with their finances, it's just becoming so hard to operate. And a lot of times we're seeing these smaller credit unions, they have a CEO that's been their CEO for 40 years. The reason they're successful is because of that one person, and they're looking to retire. And sometimes the retirement plan and the best plan for that type of a situation is for that credit union to then merge with a more established leadership team. But
That's good stuff. Thanks, Ben. So look, we're going to take a moment from our sponsors and then we'll be right back to answer some questions.
Are you an emerging fintech with a limited budget seeking more sales and partners? Introducing Strategic Generation, your partner in leveraging cybersecurity for sales and partner enablement. Fintechs often lose opportunities due to unsophisticated cybersecurity programs. That's where we come in. Strategic Generation assists with due diligence, security posture visibility, penetration testing, and on-demand virtual CISO services. We connect your systems to our partnered platform, and voila! Instant access to real-time diagnostics and compliance frameworks such as SOC 2 and PCI DSS. Gain the confidence of prospects and partners. Strengthen your cybersecurity program and drive success. Stop losing deals due to cybersecurity. Visit strategicgeneration.com and click on On-Demand CISO to connect with an expert.
And we are officially back. No, this has really been like enlightening, man. Like I didn't know. You just gave me a whole education on credit unions, and I'm just totally fascinated by it right now. So when merging with the fintechs and not merging, but in terms of working with the fintechs,
Yep.
that helps you with the agility and so forth. And because it's really the same problem that traditional banks are facing, and that's why they're going with it. So in terms of working with fintechs, what I've seen and more so in fintechs and going towards more traditional bank partnerships or sales, the vendor due diligence process, right, is pretty extensive. What are some of the things you require? Do you require them having their SOC 2? Like what are some of your requirements in working with fintechs from vendor due diligence standpoint?
Yeah, absolutely. So most credit unions will require a SOC 2, or I forget all the numbers of the ISO 2000, whatever it is. I'm sure you know it off the top of your head. But yeah, so we look for those. And if you don't have those, and what I've had to do for the last, we've been partnering with fintechs long before we did the Receipt Group and some of the other things. But as we were partnering with different companies that were earlier stage, it was different for us. We're used to the Visas, the Jack Henrys, the NCRs, people who have very large legal teams, very buttoned up due diligence package. They know what they're doing. Our lawyers can read it. It's easy, approved, done. When you're starting to say, hey, I need a SOC 2, and people are like, oh, that's expensive. I know how I'm going to do that. We start to look at, well, do you do third-party audits? Do you have some stuff like that? So we can start to do that as they are working towards a SOC 2 or a SOC 2 type 1 as a starting point, and then a SOC 2 type 2. And we would help. I had to work with my team as well to understand, hey, they're not going to have that on day one. What do we need to do to mitigate the risk so we can partner with them, try an idea before they spend all their time and effort trying to get this SOC 2 if we're never going to allow them in the door anyway. So let's make sure we're also doing our kind of partnership part of this as well. So we will do things, if we're not connecting to member data, so we'll risk rate things, right? If they're not directly connecting into member data, they're not using PII. Okay, well, they don't need to have a SOC 2. So there are certain levels and thresholds that require us to need a SOC 2 or not. A lot of the fintechs already have a direct-to-consumer version, and sometimes it's easy for us to run through that innovation lab and do a pilot with the direct-to-consumer version, just paying and offering for our members to use. And that allows us to test the idea, make sure we want to put the time and effort in, and then sometimes we'll help that fintech get through that SOC 2 certification. Some of the other things we look for, data privacy, we look at, have you ever had data breaches? Well, if you're new, you probably didn't anyway. But we look at some of how do you handle that? Do you have secure coding practices? All that good stuff that sometimes it's just easily answered by a SOC 2. SOC 2 is the easy one because we know how to look at it. When you don't have that, our security team will usually meet with the FinTechs founder, tech person, CTO, and kind of ask some questions. And some of it is, okay, you're in the cloud. What regions do you put our data? Where will it last? Where will it live? Making sure, and I think the other thing that we look at too, and we've had some partnerships held up because, FinTechs also partner with FinTechs, right? There's a lot of other services. And if those FinTechs you're working with also don't have some of the things, depending what they're doing and what services they're providing, that's another thing to consider as well. So as you're bringing on your own partners, making sure they also have, a cybersecurity program of some kind that they can then demonstrate, or you can demonstrate why, you're protecting it or why that doesn't actually affect the data. They don't have access to the PII or whatever it is. And if you can eliminate the need to have PII, that instantly reduces the kind of the risk level. So one thing we did was to provide the de-identified data. So we created a copy of our transactional database where you as the FinTech would see, let's say the account on our side is 1, 2, 3, 4, the FinTech sees A, B, C, D. And then we have a linking mechanism that allows us to know what it is. So the FinTech's just processing the data and giving it back to us to do something with versus them doing everything and then interacting directly with the end consumer member user.
Totally seen a similar model in the past in which you're providing the FinTech with basically it's anonymized in a sense transaction IDs, but then have your own mechanism in which you translate it back to
exactly.
But they can still do necessary processing that they need to. The necessary information.
Yeah, and the other kind of hack I put in there too for our kind of legal team to better understand and our risk team. So, there's the aggregators out there. There's Finicity, there's MX, there's Plaid. So when we're using one of those, it's the member who's permissioning their own data to go in there and explaining to them that the FinTech can do this direct to the consumer no matter what. And us being involved in that partnership by processing, by partnering, we're actually having better insight control help to that member of ours than if they were to just go off on their own. So by being in the loop, we actually are providing a better service to our member versus leaving the FinTech on their own, and the member too, because there's nothing stopping all those aggregators, connecting everyone together anyway. So let's be in the room instead of trying to force them out the door because we don't like it. So.
It's not the same, but in that concept, when you leave it up to the user to decide the permission, it's like an open banking concept, what they're big in EU right now. We just have
absolutely
store doing that. Oh man, really, really interesting stuff. I know I want to be respectful of your time. I know we're approaching our final mark. I want to give you now the floor, Ben, to just talk about the Receiver Group, talk about how people can find you, and I'm going to give you the floor to do that.
Absolutely. Thank you so much. So if you want to follow up, want to ask me anything, LinkedIn, very active. Just find me on there. Send me a friend request. Let me know you watched the show so I make sure to say yes, connection on LinkedIn. Receiptagroup.com. You can see all our portfolio companies. You can also see what products we're working on. We do a lot of products in the financial education space, member experience, and we're looking to sell those to community banks and credit unions. So if you're interested in anything, let me know. We'll get you set up and we'll get you some demos. So yeah. Thank you.
Yeah, good stuff. Also, I look forward to seeing you next week at Money 2020.
Absolutely. No, that'll be a good surprise. So that'll be great.
My first time attending. I'm pretty excited about it.
It's a good show. Yeah, you'll love it.
Be a yearly thing for moving forward. I think we have one more comment from the audience. It's a LinkedIn user, not sure their name, they don't have it, but very insightful, Ben.
Well, thank you, LinkedIn user. Appreciate that.
Nice. People are loving it. I love it. In general, guys, every week, 12 p.m., Tech Behind FinTech, going live, 12 p.m. Eastern Standard Time. Also, we're going to do Tech Behind FinTech on the go at Money 2020, which we're going to be getting just on the go. So this is going to be, I'm going to get people, interview them on the spot. And so it should be interesting content and insights that we gain from there. We'll be doing a daily vlog, just downloaded the things that we learned and so forth. So it's going to be a lot of information we're going to get from there. I'm going in as a Tech Behind FinTech. So have a press pass and so forth. So it should be a very interesting time. As you know, once again, the show is sponsored by Strategic Generation. You have the commercial. Their information is also in the show notes and so forth, so you can look at it there. As always, thank you very much for tuning in. We want to thank our guest, Ben Maxim. Excellent show. Thank you very much, Ben, for the wonderful insight. I feel like I started with like zero knowledge on credit unions, and I think now I'm at 55 to 60. You know,
That's
no
good.
clue.
That's good.
I started right now because the reason I love this show so much is because I'm gonna find myself. I don't know when it's gonna happen, but it's gonna happen in a conversation, and then all of a sudden I'm gonna be like a credit union expert in that conversation.
You are, for sure.
Just because of our conversation.
Yeah,
so
good.
I learned so much, and I definitely appreciate you today. When you came up as one of the guests, because we get the guest forms, and I was like, yo, I have to talk to this guy. Like it's so much there, and I want to because it's something that we see it like around my gym. I see this one credit union, but I never really thought to even. I think it was like firemen, police, credit. It was some credit.
Yeah,
I didn't really see it. But I never even thought to approach it, go inside, and then it's almost like a memory was blocked from my college days, undergraduate days, and I'm like, you know what? I literally had to go back and Google it. Like, and I don't even know what happened to my account. I don't know if I closed. I don't remember. I closed and it's still there. But this interview is done. I'm probably like 45. Maybe 30 minutes away, 35 minutes away from my undergrad college campus. When I have some time one day, I'm going to go there and I'm going to open up my account and figure out how to get it open. Alumni, so they go towards the alumni, students, or whatever. And I'm
very cool.
This conversation inspired me to get my credit union account back. So thank you very much.
Love it.
And then, well, listen, guys, thanks for tuning in. Catch you next week, 12 p.m. EST. Then take care. See you next week in Vegas. And we'll take it from there. Have a great weekend, everyone.
Take care. We'll see y'all. Bye.
Understanding the technology that powers the money is essential. Knowing the business drivers that inspire how the money is made is crucial. Bridging the gap between the mind of the technologist and the mind of the business is monumental. That is what TBF is all about. Let's start this never-ending conversation. It's time.